Hello, everyone, and welcome to the show. My name is Chris Alaimo.
And I'm Ben Gassaway. Together, we are the Amateur Investors.
This podcast is our open source journal of everything we learn about investing and wealth management.
We're here to explore the key concepts, market dynamics, and investing strategies that will assist you on the path toward financial independence and financial literacy. Our mission is to build us up from amateurs to experts.
All suggestions are our own, and we recommend that you do your own research before taking any investment advice. See you in this week's episode. We hope you enjoy it. All right. Hey, everyone. Welcome back to the show. This is episode 47 of the Amateur Investors. I'm here with Dylan LeClair. Is that correct, right?
Correct.
So, so excited to have him on. But first, before we get into the episode, quick shout out to Coinbeast. They have a wealth of knowledge, all things Bitcoin on their website, and articles and links to where you can buy Bitcoin, what are the best hot wallets, what are the best cold wallets for self-custody of Bitcoin, potential risks of Bitcoin, and much more. It's been a pleasure partnering with them to bring an episode a month for the last few months and going forward as well. Please check out episode 42 with Adam O, aka Denver Bitcoin, on Bitcoin Twitter, and episode 46 with Hodl Tarantula. I just recorded that. That'll be coming out on Wednesday. By the time you listen to this, it'll be a week from there. So check out both those episodes. So as I introduced Dylan here, Dylan was a dropout of UVM at 19 because he was sick of his words, the brainwashing of Keynesian economics, and started his own company called 21st Paradigm, where he consults businesses and people why they need Bitcoin. Joined Bitcoin Magazine as an avid writer earlier this year and published multiple brilliant pieces about why the importance of Bitcoin and the necessity for it as a humanity. Back in April, he published an article called The Conclusion of the Long-Term Debt Cycle. Dylan, thanks for coming on the show.
Thanks for having me, Chris. I'm excited to dig in here.
I hope I didn't mess up anything there. I think that was the most intro that I got. So
you nailed it, man. You nailed it.
All right. So I guess I'll start off with what I asked most people. So what got you into Bitcoin, and ultimately what led you go down the rabbit hole?
Yeah, I think I first stumbled upon Bitcoin, or I guess like more broadly crypto. I had never heard of it until late 2017. Like a family member was like deep in the ICO mania. He just like put a couple $100 in, and it turned into like I think 10,000 or something crazy. And he was like, man, dude, this is nuts. Like I don't really know what's going on, but it's like I'm getting rich. And I was like, oh wow, that's interesting. And I was like, I don't even know, like 16 at the time, so I didn't really care. But it was like, wow, $10,000, that's a lot of money. And we all know how that kind of ended up. Just like it was like he didn't even hold any Bitcoin. It was just like random coins that most people probably never heard of that all 100x or something. That was like my first touch point. And then I don't know, I like was always a numbers guy, so I kind of figured, and I didn't really love science. So my senior year, I was like, all right, I'll learn a bit about finance, right? Like stock market, economics, whatever it is. I just kind of want to learn. I want to understand, and I can kind of approach it from a quantitative side of things. So I just started reading like basic stuff about the stock market and like PE ratios and investing in general, like more broadly. And at the same time, there's like this whole crypto sphere that's like, digital money makes sense to someone our age, right? Like, but I didn't know anything about it. And so I started kind of studying more and more about like the legacy market and about why, this guy named Jerome Powell can go up and tank markets 10%, in either way, regardless of what he says. And that seemed a little just odd. I mean, like, again, I didn't know what I didn't know. I was just like learning it all at once. And at the same time, like this Bitcoin thing, this crypto market was adjacent to it. And it was just another kind of, it was another ticker on the screen for me at that point. But I had a Twitter account. And so I was like, all right, I'll see what's out there. And luckily I kind of found the Bitcoin maximalist side of things pretty fast. But yeah, I just started slowly reading and learning. And I think one of the first things I ever read was like the bullish case for Bitcoin. And so I just started, slowly learning a little bit more, and went to college for finance and economics. And at that point, like I was reading the Bitcoin Standard, and I was really started to kind of tumble down the rabbit hole, but was at the same time like really learning how messed up the Keynesian system was, the legacy system. And so I completed my freshman year. We got sent home for COVID, but that was the kind of the moment for me, March of 2020, when the economics world changed forever, at least like from my perspective. And also just, I really fell down the rabbit hole in terms of I read The Sovereign Individual. I read Big Debt Crises by Ray Dalio, and then realized like what we were living through, while it was truly unprecedented, like it wasn't, we had kind of lived through this before. Like, history doesn't repeat, but it rhymes. And like everything we were going through was like all these things coming to a head at once. And it was like, wow, there's no alternative to Bitcoin. Like I don't have a choice. I would be dumb to not go all in, both like, from a career level, my savings, all like everything. I just have to go all in. So I dropped out, and I didn't even really have a plan except to just work. I worked just a basic job to stack sats. But, I guess here I am, and working with Bitcoin Magazine, which is definitely a dream come true. I ranted a little there, but
no, that's good. I think there's a lot to unpack there. As you can see, I got my whole list of books like right here in the screen. I got The Sovereign Individuals, the last one I just finished like a couple weeks ago. So I'm there with you as well, and the Bitcoin Standard somewhere in that stack as well. Yeah, no, I think there's a lot to unpack. I mean, I'm a little bit older than you, so I graduated college in 2015, degree in chemical engineering. I've always kind of liked investing, and I thought it was very simple in the sense of when I graduated in 2015, my dad had always been lecturing to me about money and 401k and how important it was. And while I agree with like the principles of like, investing young and early and compound interest and all that, I kind of definitely fell into, I guess, the Keynesian brain trap of like, oh, just a 401k, it's fine, it's good. And I think a lot of people's awakening was this whole pandemic. Like, I really, in March, I was doing something. I was in one of my Robinhood account and a couple investing accounts. We can get into that another time, but I basically set stop losses like 4% below what like it had gone up to. So back in January of 2020, like everything got liquidated, and I was kind of like, okay, like every stock, like I had tech, I had banks, I had whatever. So I watched it all get liquidated in January. I'm like, something big's going on, and like I kind of heard inklings of the coronavirus, but I was kind of like, oh, it's gonna be like a flu, it'll pass, it's whatever. And then ultimately, the history kind of plays out that the whole economy, global economy shuts down, and basically I said this as one of my mistakes, like liquidating my whole portfolio, but it was actually turned out to be a good thing in the sense that I was able to buy, not the exact bottom of the S&P, but I was able to buy into it. So, this is April, May timeframe, thinking I'm doing great. And then that's really kind of when I started going into learning about Bitcoin, learning about what credit is, learning about what debt is, looking at the Fed's balance sheet, kind of looking at WTF happened in 1971. And then I'm like, I mean, I did the right thing in terms of it, like from stock trading or stock buying portfolio, but I'm like, what if this is all built on a bed of lies? And that's basically kind of what leads most people down the whole rabbit hole. I mean, you looked at the Fed balance sheet in 2007, they had 800 billion on their balance sheet. Right now, they're eclipsing 8 trillion. So, they've 10x their balance sheet. The S&P, I know they're buying more bonds than actual equities, although I know Preston and Greg Foss and a lot of other people suspect that buying corporate equities is here or shortly thereafter. It's like on the horizon, basically. So, yeah, I know I just ranted there as well. I guess any comment to that or addition to that?
Yeah, I think like there's a lot of people, and again, we're both pretty young, right? So like we haven't lived through, we didn't trade through 08 or even 2000, or, it's like you're just kind of learning on the fly. But I think for anybody that has been in the market for a while, or like us, who's kind of like just first now trading through it, trying to navigate this, it's like, okay, wait, this changes everything. Like, and a lot of people dumb it down to like, okay, money printer go burr. And I honestly I like the meme. It's not entirely true. Like, yes, they are trading $1 of credit with $1 of, it's not money printing. Like there is some merit to that in the sense that like, they aren't just straight up, they are creating liability and they're swapping it and yada, yada. But I think when there comes like, there's like, you have to kind of think about it a little bit when stock market hit all-time highs in June or July, whatever. And like, obviously if anybody looks around, it's like, wait, we're not more productive than we used to be. Like business activity is not at all-time highs. Why is this going up? Or like, why does everything in March, why does everything trade in lockstep limit down? Like it's not, is it about businesses at that point? No, it's about liquidity, right? Like there's some crazy charts, and this is in hindsight, but when you're looking at like S&P performance over the last year or so, and then like the month over month changes, just on a month over month time frame, the month over month change in the S&P versus the Fed balance sheet. And it's like lockstep. It's like, so what's going on? And then there's a realization that it's like, it's all a liquidity driven farce essentially. And that housing is going up, stocks are going up, everything's going up, not because, people are more productive. It's because the cost of capital is a lie. And that's driven by, again, zero interest rate policy. And then they used all of that. And then it's now the asset purchases, quantitative easing, money printing, whatever you want to call it, is essentially just distorting the cost of capital where money's free, or actually even less than free. Like in real terms, like the cost of capital is negative. So what's the fair value of an equity or anything, any asset, when the cost of capital is negative? Well, it's infinity, right? It doesn't compute. It's like literally. And so that's the kind of, the big wake up call, which is like, okay, wait, so it's broken. So what's the fix? And there's so many people that are like, there's the gold bugs, right? Or there's just the Fed haters that are just like nihilistic and like, are saying like, oh, we need a different chair, or we need to like let the bubble burst, or like all this stuff, without realizing like that's not politically feasible. It's just not, like, human incentives. It just doesn't work. And so the big realization is like, okay, wait, this guy, this group, whatever, in 2009 came together and airdropped an engineering solution to this $500 trillion, $300 trillion problem that we have, which is the cost of capital, the money, the coordination function for the entire civilization is fundamentally broken. And so like the realization that Bitcoin is an engineering solution, and it's not a one of many thing. It's a 0 to 1 innovation discovery, almost like Max Kaiser. And a lot of people hate on Max Kaiser, but
I love Max.
And maybe,
I think he's hilarious.
I love Max too. And he is a little brash at times, but he always calls Bitcoin, he says that Bitcoin wasn't invented, it was discovered, in the sense that we now have in the digital realm, in the informational realm, we have this basically perfect, unit of measure, this perfected monetary asset, which humans can use to translate value. And so that was kind of my journey last year, was uncovering that, and it was really kind of mind-blowing. It shifted my perspective on so many more things than just investing, right? Like it changed how I think about the world, essentially, which to someone that doesn't know anything about Bitcoin or hasn't kind of had this journey themselves, it might sound outlandish, right? Like you might sound crazy to a lot of your peers, which is fine. I'm sure you have some of those experiences, but yeah, I mean, the world changed, and we're living in it, and even some of the so-called experts still are trying to figure this thing out.
Yeah, I think you hit the nail on the head there. I think it was Saylor that was saying, it doesn't, like rationality has kind of broken, like the real world versus like rational thinking has kind of broken away. I mean, his perfect example is like, so you have so many of these money managers based out of Manhattan that, the city shut down for well over a year. So they had the best year of performance in their life, and they're living at their beach or their house in the Hamptons, staying on a boat. And, if they're buying just the S&P or whatever, and they went up 39%, or the NASDAQ at 46%, they had the best year of their career, not rapidly trading in and out of stocks, just buying, holding on to it, and just continually buying more, and like leading your clients to continue to do the same thing. And they had the best year of performance ever. And, you could make of what you think about it, whether the ethics of it or, just the rationale of it, but literally like reality's breaking. And not to say that they're doubling down on it, and but like it's kind of like what you said, history rhymes. Like, we basically saw what too big to fail meant in 2007, 2008, 2009, and we're just kind of repeating that. So I guess I'll continue off that. I know Ray Dalio has a video called How the Economic Machine Works. I think it's a phenomenal video. I think I sent it to one of my buddies who's not really big into economics and stuff, but I was like, dude, if you watch anything, like this is more valuable than I think a 4-year degree in economics. And not to downplay any of the professors or what they're teaching in schools, but I just think it so well uncovers how it works. I'm sure that you've watched it. I've watched it a handful of times. And I know you wrote in your article back in April, it says the conclusion of the long-term debt cycle, and I quote, "There's mathematically no way out of the current economic environment." I guess for our listeners, Is there any way for you to simplify that and explain that, Colt, and ultimately what leads us to get to that point right now?
Yeah, one of my buddies on Twitter, and I've talked to him a couple of times, Greg Foss. He really kind of contextualized this for me in terms of like the debt spiral, in the sense that the global economic system today is built on credit. Like, that's a fiat currency. Used to be backed by gold. We kind of, there's long process over basically a century, over the 20th century, went from gold-backed notes to not redeemable for gold, but essentially backed by government decree, to 1971, no gold peg, money's pure credit, meaning commercial banks create dollars through lending. So, just a thought scenario, this would never happen. But if every single debt in the world was paid off, like you just snapped your fingers, everybody paid off their debt, there would be no money. And so that's like a pretty kind of crazy realization. Like, if every single dollar was paid off, then there would be no debt. There would be no money. And so, okay, so what does that mean? Why is that important? Well, that means that essentially, to keep this kind of game going, we need more and more and more and more debt. Well, where we are today, global debt is essentially 300 or 400% of GDP, meaning so for every $100 of productivity, there's $400 of debt. And so that debt has an interest payment. And so essentially, just, ballparking a 2%, 3% discount rate, 3% cost of capital in nominal terms, not real terms, adjusted for inflation. But if you're just saying all this debt has on average a 3% interest rate, that means that just to keep the debt flat, our debt levels across the world flat, the global economy would need to grow at a 12% clip a year, 3% times 400% debt to GDP.
400%, yeah, exactly.
And so that's not happening. Like, we're just not growing at 12% a year. And even if we were, kind of going on the Jeff Booth side of things, productivity in the 21st century equals things cost less, right? Because technological innovation, where we're going, it's more for less, right? Like, think, what would an iPhone cost in 1950? It would cost, besides the fact that no one else has a phone, so there's not really a network effect there. But think about all the information that's available. What would that have been worth 50 years ago? Well, it would have been worth all, there's no amount that it could have been worth. It's infinitely valuable. And so the fact that we have this here today for $1,000 or $500 or even $100 smartphone with an internet connection, like that is productivity can't be placed in the CPI gauge, right? Like, and so now we have all this global debt. Productivity is increasing, but the gains come they come with lower prices. They don't come with number go up GDP. And so we have these insurmountable debt levels that continue to get bigger every year, and governments and central banks have a mandate because of kind of how the old world works, to keep this system glued together. And the only way they can do that is by expanding the debt, is by increasing the debt levels, because without it, the house of cards basically all falls down. And that tried to happen in 2008, in 2020. That was like a self-correcting mechanism. There's too much debt, it's going to liquidate. It was like the market was screaming that this is mispriced. This the fair value of equities isn't, the S&P isn't worth 3,300, or like this house isn't worth 10 times the median worker's wage. So there was, the debt was trying to liquidate. Just free market mechanism. Well, ultimately the free market doesn't exist because we have central banks and governments, which we kind of talked about. And so mathematically there is no way out, except what they're trying to do today is inflate it away. So they'd be like, all right, well, if the only way we're going to get out of this debt level is by letting inflation run and keeping interest rates pretty low and just hoping the debt just kind of melts away. But ultimately there's people like you and I and a lot of other people like Michael Saylor who are saying, hey, like, I don't want to play this game. I'll just opt out. And so, in prior, decades or a century ago in the 1930s, there was a big debt bubble. It burst, and FDR was like, all right, yeah, well, no gold. You can't have any gold. The banks just don't, like, we're not going to let them we're not going to give you your gold. The banks have it and we just confiscated it. Well, you can't do that with Bitcoin because I hold Bitcoin in my head. You do, you have it wherever. Like, you have this global, and it's like, it's not just a regional thing. It's not just the US, it's not just Canada. Like, this is a global scale. And so the fact that debt everywhere, the cost of capital everywhere around the globe is this manipulated and this mispriced. It's something that most people don't understand. And rightfully so, right? Like, I understand not everyone's a macroeconomic expert, and by no means am I saying I am, but but I would say that I've contextualized a problem, and the solution is obviously what we're talking about, which is Bitcoin.
Yeah, I think there are a lot of good points there. I think exactly what you're saying. We'll go back to the iPhone example of, like, Jeff Booth saying inflation or technology is deflationary by nature. It's trying to drive prices down to give more value to everyone else. The iPhone, like you said, in the 1971 or whenever, what would be the price of an iPhone? Okay, yeah, it doesn't have the network effect, so you don't have as many people. But imagine having a phone, an internet connection, a way to call, text, do all these different features in one. And I remember when the iPhone first came out, a lot of people were saying, oh, well, like, a camera is still better than the iPhone camera. And, oh, a calculator is still better than the iPhone calculator. And while that may be true, it's still the ease and convenience, and especially with the App Store and a lot of different technologies that they added to it, you can download a better calculator. You can download a better, improve the camera, or the newer versions have much better cameras now. But all these things are deflationary. So at the same time that the value of the iPhone is going up, subsequently, they're also destroying other companies and markets. The demand for cameras, not that I know it offhand, I would only assume they went down as everyone's smartphones, not just iPhones, have better cameras that they carry around in their pockets versus needing a calculator, needing a camera, needing a compass, needing all these different utilities that were kind of built into one device. I mean, I think that just kind of makes sense. I know Preston.
There's also an important distinction with, like, a lot of people, and especially like the Keynesian school of things. I've seen a lot of tweets recently, like over the last month. It was like debunking Bitcoin, and it was like the conclusion was like, Bitcoin can't work because deflationary money means no one will spend anything and productivity collapses. And it's like, okay, going back to first principles, there's a fundamental difference between technological advancement, decreasing the cost of living, and increasing productivity, giving people more for less. There's a difference between that and credit contraction due to fractional reserve banking, right? So the Great Depression, there was basically, you had your gold-backed notes, right? You could go redeem your paper for gold, and there was a ginormous asset bubble due to speculation and basically a centrally planned cost of capital. And so when that all collapsed back down onto gold, there was a ton of pain that was felt, and people thought their wealth, which was in stocks and real estate and whatever, they thought their assets were worth a lot, which they really weren't. And so when that all collapsed down, well, now you have a bunch of liabilities that are still there, and your assets are falling way down, and you feel poor, and productivity decreases, and people's spending and investment decrease. But deflation is different than technological advancement. And I think just being able to understand that distinction, which I'm sure you do, right? Just from a first principles basis, like that, it's just such an important point that, like, these so-called expert PhD economists can't understand.
And it's funny too. I mean, I think most Bitcoiners, I know we get the rap of toxic Bitcoin maximalism, and for the most part, I will agree there is times when it is overboard. I'll be the first to say that. But there's definitely, I don't feel bad with like the Steve Hankes or the Peter Schiffs when they're saying things. And it's like, listen, you guys are like, whether you're trying to get money out of it or trying to manipulate people's thoughts or thinking, I don't feel bad when people go after them. It's like, we're trying to explain it. And I think a lot of times when someone's like, I don't understand this, it doesn't make sense, for the newcomers, for the most part, I've seen more often than not, people are very welcoming and opening to teach people about it, to teach them what it means to have Bitcoin on an exchange, what it means to putting into cold storage, what it means for a hot wallet or a cold wallet, what it means for, multi-sig. Like, there's many different facets of it. And I think, tying back to your last point, like the reason they were able to do what they did in, I guess, what was it, 1933 with basically they confiscated all the gold, is because basically the banks held the majority of it. And then basically they made people fork it over that they didn't, aside from jewelry and like such as rings and or necklaces or earrings and stuff. But aside from that, they confiscated any coin or bars of gold that basically they were held by the central bank. So if the government writes a decree, the banks just have to kind of rely on them or kind of deal with theirs. Where Bitcoin, if you were to ban it, I mean, we already have cases of Nigeria where they banned it and then peer-to-peer adoption skyrockets through the roof. It actually, you see an uptick in adoption, and actually, not that it creates a black market, but essentially does. Like, I know there's a saying that bad money drives good money into hiding. And that's true historically, whether it's, seashells, gold, cattle, whatever, frame of history that you want to look at. When a currency is collapsing, or even over a long period of time, not just instantaneously, over years and or even decades. When you hear about Rome with gold clipping, when they were clipping the coins, the good money was going into hiding, and people were storing it and keeping that while they were clipping the coins and devaluing them. So I think that just historically shows it. Kind of tying into talking about how like we're building this whole economy on a house of cards. I know I love Preston Pish's analogy. It's like telling someone to build a house, and, you kind of hand them a ruler on the first day, and they're like, okay, I want the dimensions of the house. And then the next day you give them like a yardstick, and you say, or you give them like an inch, and then a ruler, and then a yardstick. And then every day you give them a new measurement tool, and you say, it's got to be the same amount. But instead of having the markings on the ruler or yardstick or whatever, like it's just a plain ruler, but you say, figure out what an inch is based on this ruler that's unmarked, or this yardstick that's unmarked, or this tape measure that's unmarked. So you're like, all right, I'll try and do my best, but like it's ever expanding, and you're assuming this is an inch versus this is an inch versus this is an inch versus this is an inch. So it gets out of hand and it gets crazy. And there's no way me, you, or even the best builder would be able to build a good house with just the estimate of that alone. So
yeah, we're so far down that path that like, it's unbelievable the misallocation of capital that's just continued to persist. I mean, we have like with just like the VC bubble, right, where you have $1 billion, $100 billion companies that can't churn a profit. Like, that's all just a result of distorted, manipulated cost of capital. And like it's everywhere. Once you see it, right, once you like see kind of past this farce of like, okay, what is money? Okay, wait, money wasn't always just government, debt paper, essentially, like IOUs. And so once you see that, and then you look around the world and see all these like the craziness, even like, we don't have to go down this path, but like looking at the COVID and economic lockdowns and what's happening in Australia, and like, how can a government be like, oh, we're locking down and we'll pay you to stay home? Like, how does that work?
Yeah.
It doesn't. But the fact is that they have this monopoly over money, which is basically
Money
all the
violence.
value in the world. And so, yeah, that's something that I don't accept. And so I vote with my money.
Exactly. And it's funny, even though, we give Peter Schiff a lot of grief for his opinions on Bitcoin, I think like I agree with like 90% of what he says. It's just funny that he doesn't see the value in Bitcoin. And I know he was on Pomp's podcast recently, or his show, The Better Business Show. And the one thing that I found really difficult with like Peter saying like, oh, we want efficient markets, and, I'm all about the free market, and, whatever people want to use. And then he's pushing people towards gold. I'm like, dude, if he lives in Puerto Rico like he does, and I live in the United States, and I want to send him gold, what's more efficient? I can wire him or send him Bitcoin instantaneously over it for a much cheaper cost than I can send gold. Even if I, insure the package for gold and, package it up and the weight of it and all those different things, like what's going to happen more instantaneously, faster, cheaper, and better? And I know he's like, oh, it's a Ponzi scheme, and says all these ridiculous things. I'm like, dude, what are you talking about? Like, even not even using the Lightning Network, which gives it added benefits, even just doing an on-chain transaction, you can do it much faster than I could ship gold to him in a heartbeat. So I really don't understand, like, he's all about like free market economics, and basically we're saying that the free market's saying that it likes Bitcoin over gold. That's what we have of 12 years. And then he goes, oh, well, but like we have this 5,000 year history for gold. And that's true, but like we had a 10,000 year history or billion year history of seashells. Why don't we still use those? Those have been around longer than we found gold. Like, like I think his like first principles, or he doesn't use first principles, but his thinking just like decays at that. And I've never heard a really good argument. I even like, I always like saying this analogy when Saylor was like, if you want to transport $1 billion worth of gold from, let's just say, the East Coast to the West Coast, because you're moving or whatever it may be, to do that, it's about 1,000-hour exercise, and it's about $5 million to do that. You have to hire planes, pay off government officials, get security, forklifts, planes, whatever it may be, pilots, you name it, the gambit. Where if you wanted to send $1 billion worth of Bitcoin, it would cost about $5 and it would take about an hour. So, I mean, when you just look at that, it's a billion-time improvement on what gold can do at the same store of value, or at least when you're looking at it at base level. So, I mean, with Bitcoin's market cap, I mean, what are we right now? We're at like 870 billion. I forget what I looked at today, but 870 billion or 800, somewhere in that range, the 800 to 900 billion range. And gold's market cap's 11 trillion. I mean, it only makes sense that it sucks up that money. And then we're not even talking about, the $18 trillion of, negative yielding bonds. So that's just the tip of the iceberg, the 11 trillion of gold. Then you can go into bonds, then you can go into equities, then you eventually can go into real estate, and what it really becomes a monetary standard.
Yeah, I mean, so like we used to be on a gold standard where basically gold was the unit of measure for all, for like the global economy, and the gold was the one money. And obviously there was banknotes on top of that, but essentially like all of the gold was, was equal or about equal to like all of the world's productivity. Gold was the most, saleable, fungible, just unit of account for the global economy. The gold standard, most people probably don't know what that phrase is even from, but the gold standard was because humanity converged upon the gold standard. But funny enough, like over the last 100 years, yes, a gold coin buys a fine man's suit back in 1900, and so it does today. But now gold's at 11 trillion, and the global economy has 400 to 500 trillion dollars of assets. Essentially, like gold has done what it's done. It's a pet rock. Yes, there's industrial use cases, and wearing it as jewelry, but really, like, it's been demonetized already in a sense that like it hasn't increased in purchasing power as productivity has, where you now have $200 trillion, $300 trillion, whatever the measure is, in global bonds that are essentially money. Like bonds are money, like, and essentially it's backstopped by the central banks of the world, where, bonds have taken the place of cash as money. Debt was monetized, and I would argue now, honestly, equities with bonds, all of their upside basically being gone, equities are now money, at least in the West, right? Like, hey, just get a 401k, passively invest over 40 years. It'll, when you retire, you'll have $1 million or whatever it is to live off of. Like, what kind of capital allocation is that? Just blindly buy a basket of every business at any price. Like, well, that's not investing. They're just quasi saving, right?
Yeah.
So like, and people aren't buying gold. People are buying, bonds, equities, real estate. So like, and it's all just kind of the search for this monetary, store of value, this monetary premium. It's like, where can I store value and preserve it or grow it, hopefully across time and space? And so, yeah, Bitcoin is just an engineering solution. Gold, when an Austrian economist like Peter Schiff, unironically says Bitcoin has no intrinsic value, without realizing like intrinsic value is a fallacy, and that value is subjective, and it is in the eyes of like, the holder of the asset, then or anything really, then you can just kind of throw everything that he says out the window. Like, intrinsic value is not a thing. Yeah, there's production cost of a certain asset. You could say that for sure. But what's an ounce of gold worth to me? I mean, I guess not too much, not worth, infinity, which I kind of think of Bitcoin being denominated in dollars. How much is a Bitcoin worth? Not 50K to me. It's worth $10 million. It's worth, and so there's that mismatch. There's that overlap that, guys that say Bitcoin has no intrinsic value, I just basically disregard them for the most point. I mean, like, I can't imagine learning about Bitcoin at $1 and saying the same thing and watching it, go up 10,000% over a decade. Like it, maybe he gets it, but he'll never go back. Like you just can't. It's just like sunk cost fallacy, honestly.
I mean, luckily for him, his son is a big Bitcoin bull. So, the running joke is that Spencer's going to be taking care of him when he's old. So, Peter Schiff's not the one I worry about. I mean, his net worth's in the multiple hundreds of millions, or at least multiple millions, clearly. So I'm not worried about him. He will be fine in the grand scheme of, how he compares to everyone else in life. I'm worried about the people that, like you said, the people that are trying to save their way to wealth, whether that's saving their money until, retirement, or just trying to even save money in a bank, which is even worse. So yeah, I mean, those are the people that I look out for, and I want the best for, and I see Bitcoin as that exit or escape hatch to getting out.
Yeah, I mean, that's what. Yeah,
go ahead. Go ahead.
I mean, I'm just passionate about Bitcoin basically for that reason. Like, I think I get it. I buy every day, but like I would say I evangelize Bitcoin because I think it's, I don't matter in the grand scheme of things. I don't think even like the Michael Saylors of the world, they don't matter in the sense that someone else would come along and just basically speak the truth about what's occurring here. None of us are too important, but I evangelize it. Not because like people are like, oh, you're trying to pump your bags. I'm like, dude, I hate to break it to you, but like your $100, your $1,000, your $10,000, your $10 million don't matter for this $1 trillion monetary network. It's completely insignificant. I'm trying to help you. And that's something that like, a lot of people don't understand. Like I'm constantly bringing up Bitcoin because I care about your future, or like, I want you to make it on the other side of this. And that's something that I think is kind of lost a lot of times. Like,
Yeah, I think, and this is just me. I think the next, we're currently in the current bull cycle. I think when the institutions really start coming, I think we are going to have another bear market. My assumption is they're going to see a lot of their gains. They're going to be very, very happy with it. And then they're going to, they can move markets up and down, like collectively. As they see it tanking, they bail out. And I see that as more opportunities for people to get in. I know there's a lot of theories on the super cycle theory. I don't think it's this 4-year cycle. I think it might be maybe the next one, but I definitely could see, Bitcoin making 100% move up or 200% move up. And then the institutions being like, oh, well, if you look at the cyclical history, we should sell at a top, and then they move it down and up. But I think over the long time frame of it, everything, the macroeconomics of it happening, I think maybe Bitcoin would lose its value if they stop printing. But basically, like what you and Greg Foss bring up, like they're their backs against the wall. They have to pay off debts. So like it's almost like I think he always brings up the asymmetric hedge or bet to it, that basically we know it's going to happen. So it's a great trade in the sense of like you're protecting your wealth, you're protecting, the downside or upside. And there's a lot of upside versus downside.
Yeah. Like one is that they can't stop printing. I tweeted yesterday, the stock market going up, equities rising is a matter of national security in the United States. And some people, I had some quote retweets that were like, this guy's such an idiot, or like whatever. And it was like, no, I think like you don't understand, and that where we are as a nation, as the world reserve currency, running a twin deficit, meaning we produce less than we export less than we import every single year, and we have a budget deficit, and we can do that because we're the world reserve currency. We essentially, our biggest export in the U.S. is our paper, is our dollars. And so we've kind of, hollowed out our domestic manufacturing base. Our capital markets are engorged with all of this, excess liquidity because of global demand for dollars, unnatural, artificial global demand for dollars. And we have basically an entire nation of people that are using financial markets, housing, bonds, like we talked about, as savings accounts. And with the way that a fiat monetary system works is that a dollar is created through lending, like we talked about, but it's also destroyed through default or repayment. And so when you have defaults, like the reason that Evergrande, this Chinese developer, it's like, why is that somewhat important? Why are people keeping an eye on that? Well, it's not just about them. Like, if they default on their I think they have like a couple $100 billion in liabilities, but in terms of actual like bonds, like that they owe, it's like 20 billion or 50 billion or something, which
I think it was
is
like 30
significant.
billion, and I think their total liabilities were 300 billion, I think.
Yeah, so I mean that's significant, but like, okay, 50 billion, 30 billion in a 10 trillion, $100 trillion pool of assets, like why is that important? Well, it's because of contagion, in the sense that if I owe you money, and you have on your balance sheet, you have a bond, and I have debt, liability, and I don't pay you, well, all of a sudden the asset side of your balance sheet's impaired, and the money you thought you had isn't there, and so now you're less creditworthy, you have less, your asset on your side of your balance sheet's lower, and it's just it spreads like wildfire. Money is being in like a deflationary scenario, credit contraction, literally money is being destroyed. And so the wealth that people thought they had is declining, and your liabilities are still there. And it just literally, if the government didn't step in, like no stimulus packages, no deficit spending, the Fed doesn't monetize anything, literally like everything would go to zero. And that sounds crazy, but like it would literally all unwind to zero because of how the credit and the fiat monetary system works. And so like they have to step in and print. And that's like one of the things that like people don't understand is like stocks have to go up because at this point in the economic cycle in the monetary system, they have to print. Otherwise, like everything unwinds. And no one's going to go, if we're talking about political incentives, no one's going to get elected being like, I think we should pay off the debt and implement austerity and cut social spending. And no, the people that are going to get elected are like, the AOCs of the world that are like, free this, free that, free, without, obviously we understand it's not free, but the basic incentive is to just print. And so, when you're thinking about Bitcoin, I honestly think I am a believer that the halvings matter. And I think they matter in an increasingly, diminished amount, but, and I think there is merit to like a 4-year cycle in human psychology, and just kind of, how honestly, I think it's less about, people dumping, even though it, obviously people are selling, but more about like just demand, like the marginal buyer is exhausted, where like, you have so many people holding, right? And if you're looking at like, do you know what like realized price is? It's kind of off topic, but like,
yeah, I think so. If you want to explain
so like,
it real quick.
Yeah. So when you're looking at like the Bitcoin price, or if you're thinking about market cap, right? Market cap's 900 billion. And so if you want to look at like realized price or realized market cap, that basically just takes the price that every single coin has ever moved at. So if in this calculation, Satoshi's coins are worth zero because they were mined when Bitcoin had no market value and they'd never moved. So, and likewise, a coin that was, sent to a wallet in April is worth 60,000, even though the price today is 41 or whatever it is. Mm. And so in this realized capitalization metric, it's kind of like the value of every coin that was when it was acquired. And as old coins exchange hands, that metric ticks up. And so like realized price right now is like 21,000 and the price is like 41,000. And what you see is essentially like the ratio of the relationship between the market price and the realized price. Every bull run explodes. So what does that kind of mean? It means that you have a bunch of people that aren't selling at all. They're holding. They're acquired a bunch and we're sitting on our hands. And you have this new influx of demand. Back in 2013, it was just kind of speculation, maybe Silk Road, drugs, whatever it is, right? 2017, you kind of have this new bubble as well. 2021, institutions, you have this new class of investors, but they're all fighting for like this tiny free float of the supply. And so price gets bid like crazy because they're all competing for this tiny marginal amount of Bitcoin. And so the price goes parabolic, and naturally you see people sell, but it's less of like, there's just not enough demand to meet all of these new coins that are kind of exchanging hands. And so that's what we've kind of see when you see all these like micro bubbles throughout the history of Bitcoin, is that kind of dynamic playing out. It's just price is set at the margin, but the price goes parabolic just because there's this diamond-handed class of hodlers, and that obviously kind of is a self-correcting mechanism, and you'll see the drawdowns. What I think is different this time, and I'm not saying we're going to see a super cycle, is I think that Bitcoin at $1 trillion, and probably in 2022, Bitcoin at $3 trillion, $5 trillion, whatever, whatever crazy amount Bitcoin runs up to, it's intertwined with the macro environment. And that I think is like pretty important, right? Like we're seeing like Bitcoin went from 8,000 to 3,800 overnight, March 13th, 2020, right? Like Bitcoin has macro liquidity, and during a liquidity crisis, it's going to tank. But I think where it gets really interesting is that when Bitcoin is not a $200 billion asset, it's not a $1 trillion asset, but Bitcoin's a $5 or $10 trillion asset with global liquidity. I think the tail might wag the dog in the sense that a Bitcoin correction can send markets spiraling down, or vice versa, right? In the sense that the Bitcoin bubbles and the the crashes or the parabolas is more a reflection of the dynamics in the fiat monetary system kind of crumbling, right? Where it's like this pure, like Bitcoin is like this pure reflection of the health of it's like almost like the smoke alarm of the fiat system dying, right? It's like, the house is burning and like, look at this thing going parabolic. I think that's where it gets interesting, where it's less, at some point, it's going to be less about the Bitcoin price appreciating and more about, hopefully it's not ugly, but like a collapse in the dollar, but before that, all other fiats. And so that's when the kind of the 4-year cycle and these historical trends that we've seen for the last decade all break down, where it's, if trust breaks down.
Yeah, thanks so much for that, Dylan. I know you got to get going quickly or shortly, so I'll ask my questions pretty rapid fire here. But thanks so much for coming on. Really appreciate your time, and I know you're busy. It's a pleasure to have you on. And I know Greg always hypes up the youth like you and me and Will and stuff, saying he's very hopeful for the future with us, which I hope is the case. But quick questions here. So I guess what's your biggest investment or business mistake you've made? And I'm not going to say because you didn't find Bitcoin earlier. I think that's a cop out of most Bitcoiners have.
That's tough. That's really tough. It's short lived. I would just say I've speculated a little bit with like options and stuff, and just like directionally correct but lose out because of
timing.
Yeah, and just like you're trading options, and it's you're talking about implied volatility and all this stuff, and directionally correct, but you lose out because you're trading against algos on Wall Street. So like I just kind of figured out the stack for the most part, and I'll speculate a little bit, but luckily I don't have any catastrophic blow ups or in my short-lived investing career.
That's good. All right, favorite book, podcast, YouTube channel, or website that you like to go for investing information? It can be Bitcoin related, not Bitcoin related, whatever you want it to be.
This is a cop out, but I'd say Twitter. Twitter is definitely like it's unbelievable that the website's free, and just like you can curate your feed and basically get more value than far more value than a college degree. So I would say anybody that's not on Twitter, and especially like Bitcoin related, get on there because it's a wealth of knowledge and information. But I mean, that's kind of a cop out, but I would say definitely Twitter.
All right, I'll take it. And then I guess thanks so much for coming on. I guess where would you direct people to go to find out more about you? I'll allow you to plug your website or your Twitter handle and all that.
Yeah. You just find me on Twitter at Dylan LeClair _. I do stuff for Bitcoin Magazine. I lead their premium markets products. So it's called The Deep Dive. We cover like global macroeconomics, derivative markets, and on-chain analytics and stuff. And so just covering the day-to-day, week-to-week, month-to-month trends, but also kind of zooming out and like this is much bigger than just a ticker on a screen. Like what's unfolding is the monetization process of Bitcoin. So I encourage people to check that out. I can hook you up with a free sub if you want.
That'd be awesome. Yeah, I'd love to check that out. Definitely.
Yeah. And besides that, I do some kind of side stuff with consulting. Basically, just orange pill as a service is how I would describe it. Just trying to spread the good word, trying to get people onto a Bitcoin standard as onto the arc, I guess. So yeah, I mean, I had a lot of fun, man. It was really nice to get to meet you and to come on. So I appreciate you having me.
Of course, man. I'm happy to meet you, over Zoom, and hopefully we'll meet in person one day. As everyone knows, you can go follow us on Twitter. You can follow us at our website. You can send in an email through that. We're building Bitcoin nodes for people. So I know, we're kind of doing the Raspberry Pi method of building a node and shipping it out to people. So we've had some success doing that so far, helping people run their own Bitcoin nodes. So really excited for that service. And, have a good one, everyone. Catch you next time.